Hello, this is the Workaholics, and we'll be talking about cash flow. Operating activities is an accounting item indicating the money a company brings in from ongoing, regular basis activities like manufacturing and selling goods or services. These activities will provide the majority of company's cash flow and will largely determine if a company is profitable or not. Cash flow from operating activities doesn't include long-term capital or investment costs, but it does include earnings before tax plus depreciation minus taxes. Here's an example of operating activities. An apparel store's operating activities would include buying materials and paying for labor to produce clothes, paying to transport the materials to the factory and the clothes from factories to the warehouse, arranging transportation from warehouses to retail stores and mail order customers, paying employees to work in warehouses and retail stores, paying managers to oversee operations, paying rent on warehouse and rental facilities, and many more. The statement of cash flows is made up of operating activities by a company's investing and financing activities. To get a feel of how a company receives cash flow from operating activity is accountants add depreciation expenses, losses, decreases in current asset and increase in current liabilities to net income, then subtract gains, increase in current assets and decrease in current liabilities. Investors always examine a company's cash flow from operating activities separately from the other two components of cash flow, which is investing and financing activities. They do this to see where a company is getting its money. The goal is to obtain positive cash flow because of positive income from recurring operating activities. Positive cash flow that results the company to sell off all of their assets or because it has recently issued new stocks or bonds will result in a one-time gain, but is not an indicator of financial health. The company's balance sheet and income statement will determine if the company is financially healthy or not. Cash flow from operating activities is reported on the cash flow statement in a company's quarterly and annual reports. When you compare cash flow from operating activities with earnings before interest, taxes, depreciation, and amortization, you will have insight into how a company finances short-term capital. Cash flow from operating activities exclude dividends paid to stockholders and money spent to purchase long-term capital like equipment and facilities, because these are also one-time or infrequent expenses.
Investing activities are deals or transactions involving the sale or purchase of equipment, plants, properties, securities, or other assets generally not held for immediate sale, also known as long-term investments. Investing activities may sound like the amount of money a company generates from investments it has made, but the accountants who fill out corporate balance sheets are generally not referring to the number of shares of IBM the company has bought or the number of municipal bonds it has sold. Rather, from a corporate perspective, they are generally referring to money made or spent on long-term assets the company has purchased or sold. Examples of investing activities are cash payments to acquire or construct long-term fixed assets such as a plant, machinery, vehicle, equipment, etc. Cash receipts from sale of property, plant, and equipment, and intangible assets such as buildings, copyrights, etc. Cash payments to purchase bonds or shares of other companies. Cash receipts from sale of bonds and shares of other companies. And cash payments in the form of loan and advances and receipts related to payback of such loans and receivables, etc. Related to investing activities, capital expenditures are a figure representing the amount of cash a company spent on items that last a long time, such as property, plant, and equipment. Basically, capital expenditures, often referred to as CapEx, are brick and mortar types of investments that are necessary to keep the company running and growing in its current form. For example, in order for a supermarket to keep operating and growing, it will typically need to remodel its existing store replacing its equipment, and build new stores. These expenditures will show up in the CapEx line item in the cash flows from investing activity section. When analyzing a company's cash flow statement, it is important to consider each of the various sections which contribute to the overall change in cash position. In many cases, a firm may have negative overall cash flow for a given quarter, but if the company can generate positive cash flows from its business operations, the negative overall cash flows may be a result of heavy investment expenditures, which is not necessarily a bad thing. As you can see in the example of this investing activity cash flow, the company has spent money on investing in a new plant and building and received less returns from other investments, so that net cash flows are negative. But this is not necessarily a bad thing, because the new plant and building could bring in more returns in the coming years from the investments they've made this past year.
Financing activities are transactions between a business and its creditors and investors. Cash flows from financing activities is a line item in the statement of cash flows. The statement is one of the documents comprising a company's financial statements. The line item contains the sum total of the changes that a company experienced during a designated reporting period that were caused by transactions with owners or lenders to either provide long-term funds to the company or to return those funds to the owners or lenders. If the company is not for profit, then you would also include in this line item all contributions from donors where the funds are to be used only for long-term purposes. Sale of stock, which is positive cash flow, repurchase of company stock, insurance of debt such as bonds, repayment of debt, payment of dividends, donor contributions restricted to long-term use. All of these are items included in this particular area. The cash flows from financing activities line item is one of the more important items on the statement of cash flows, for it can represent a substantial source or use of cash that significantly offsets any positive or negative amounts of cash flow generated from operations. On the other hand, a smaller organization that has no debt and pays no dividends may find that it has no financing activities to report in a period, and so does not need to include this line on their statement. You would delve into the reasons for a large positive or negative balance in the cash flows from financing activities, since it can, for example, denote the need for a large loan to support ongoing negative cash flows from operations. Thus, large amounts in this line can be considered a trigger for a more detailed investigation. When it comes to issuing equity, companies can issue shares through an initial public offering. The company's proceeds would be the listing price multiplied by the number of shares issued, minus investment banking fees. Publicly traded companies may also issue additional shares to investors and use the proceeds to finance operations or expansion plans. You can issue debt, and these transactions include borrowing money from financial institutions, like loans and lines of credit, and issuing bonds to investors. These short and long-term loans and bond sales help businesses fund operations, which may involve plugging temporary cash shortfalls or financing capital investments. Retiring debt is a financing activity that uses cash. If a small business has excess cash, it may decide to pay its own outstanding debt, which includes buying back bonds from investors and paying off the balance on outstanding lines of credit and loans. Paying down debt reduces the amount of liabilities on the balance sheet, which improves a company's liquidity position. Companies also save interest expenses, which goes straight to the bottom line and increases cash flow. Paying dividends are financial activities that also require board authorization. Some companies may pay dividends every quarter, while others declare special one-time events. Shareholders receive a set amount of cash for each share of stock they own.